Welcome to this episode of PhillipCapital's Market Watch. I'm Glenn Thum, Senior Research Analyst from Phillip Securities Research. Today, I'll be sharing our recent initiation on the US banking sector, focusing particularly on JP Morgan, Bank of America, and Wells Fargo. Let's begin. So why are we initiating coverage on the US banking sector? Let's jump straight ahead into the three investment merits we've identified with a focus on the three banks mentioned earlier. First and foremost, exceptional market share. JP Morgan, Bank of America, and Wells Fargo are the leading banks in the US, holding about 40% of the total assets in the banking sector. As of FY23, JP Morgan boasts the largest market share at 17%, followed by Bank of America at 14% and Wells Fargo at 9%. These banks also excel in loans and deposits, securing 28% and 32% of the market respectively. Furthermore, the bank failures in 2023 have bolstered their presence, with their share of total assets rising from 38% in 2022 to 40% in 2023, and deposits increasing from 31% to 32% in 2023. Their dominance in the sector enables them to handle a significant number of transactions and deposits across all business segments. Secondly, peaked rates serve as a catalyst for the banks. The Federal Reserve's or Fed pivot from an aggressive rate hiking cycle to a potential rate cutting stance in 2024 marks a significant turning point. When the Fed raised rates aggressively in early 2022, the banks were immediate beneficiaries as assets tied to the benchmark leading rates were repriced to pay the bank's higher rates almost immediately, while bank deposit costs lagged. This resulted in higher margins at virtually no cost. However, this reversed in 2023 as the cost of fund repricing exceeded asset repricing, resulting in diminished margins across the sector. With rates reaching peak levels and potential rate cuts expected in the second half of 2024, we foresee asset repricing to retake the lead from deposit repricing for most banks in 2024. Lower rates could also bolster valuations. Thirdly, a benign provisioning cycle. The management of credit losses by banks has normalized from the unusually low levels observed during the pandemic, with no significant signs of credit quality deterioration. While some losses are anticipated, particularly from the commercial real estate sector, banks have been monitoring these portfolios and set up specific loan loss reserves. Additionally, there was no excessive lending in 2023, as nominal GDP growth outpaced loan growth. With these considerations in mind, let us now focus on the individual banks and why they stand out to us. We will now do a quick comparison of the three banks. JP Morgan, the largest bank in the US, boasts a diverse business portfolio and the most significant international presence among the three. Its revenue is split between net interest income at 56% and non-interest income at 44%. Bank of America, the second largest, leans more towards net interest income at 58% of total revenue and has a predominantly US-based asset distribution, with 87% of total deposits in the United States. Wells Fargo, ranking third by market share, stands out with its extensive branch network and a significant revenue contribution from net interest income, which makes up 63% of total revenue. Despite having half the assets of JP Morgan, Wells Fargo's branch count is nearly as extensive, indicating a strong middle market presence and potential for deposit growth. Starting with JP Morgan, our first investment merit would be the bank's strong and consistent earnings. JP Morgan has consistently outperformed consensus expectations with its earnings per share. The ability to exceed expectations for 6 consecutive quarters demonstrates the bank's resilience and adaptability in various market conditions. This consistent performance can be attributed to a combination of factors, such as diversified revenue streams, efficient cost management, and strategic investments. It also indicates that the bank has been successful in navigating economic uncertainties and market volatility. Secondly, JP Morgan's positive net interest income outlook. JP Morgan's 2024 anticipates a higher than expected net interest income of around $90 billion. The bank's ability to maintain a positive outlook, even assuming 6 25 basis point rate cuts, indicates its resilience in the face of potential economic downturns. Growth will come from loan growth, driven by card, offset by moderating net interest margins from continued deposit repricing and migration. Thirdly, JP Morgan's commitment to its share repurchase program at the current net pace of around $2 billion per quarter signals the bank's confidence in its future earnings potential. Common stock repurchases rose 217% year-on-year to $9.9 billion, in FY23, with 69.5 million shares repurchased. Maintaining this pace could potentially lead to a year-on-year increase in FY24 earnings per share of around 2.4%. As such, we initiate coverage on JP Morgan with a buy and a target price of $231.19. Moving on to Bank of America, our first investment merit will be the bank's ability to manage its net interest income, decline, and control expenses. The bank's 2024 outlook points to manageable declines in net interest income in the first and second quarter of 2024, before modest growth in the second half of the year, alongside a slight growth in expenses. This suggests that the bank has a robust strategy to manage its net interest income and expenses, which could be significant drivers of its profitability in the future. Secondly, the bank's effective loan portfolio management. Bank of America saw a 1% increase in loans, showcasing its effectiveness in expanding its loan portfolio while managing the associated risk. The growth in loans has the potential to bolster interest income and contribute to the bank's profitability. Thirdly, the bank's sound asset quality. Despite higher non-performing assets and net charge-offs, Bank of America's provision for credit losses was better than anticipated. This suggests that the bank has been able to effectively manage its credit risk, ensuring that potential losses from bad loans are adequately covered. As such, we initiate coverage on Bank of America with an accumulate and a target price of $40.82. Last but not least, we have Wells Fargo. Our first investment merit would be the bank's softer net interest income outlook, offset by their controlled expenses. Wells Fargo's guidance for 2024 indicates a potential decline in net interest income, but this is expected to be offset by modest growth in the second half of the year. Additionally, the bank expects only a slight increase in expenses, which suggests that Wells Fargo is effectively managing its core income and cost drivers. Secondly, Wells Fargo demonstrates resilience in fee income. The introduction of new card products has stimulated an increase in customer expenditure. Additionally, Wells Fargo has been channeling investments and expanding its workforce in corporate and investment banking, particularly in trading, leading to a rise in both revenue and market share. The elevated market levels compared to the previous year are also expected to enhance fees in wealth and investment management. Thirdly, an increase in share buybacks. Wells Fargo's management noted that buybacks will surpass the $12 billion in FY23. Common stock repurchases rose 98% year-on-year to $12 billion in FY23, with 272 million shares of common stock repurchased. Assuming a modest 10% increase in Wells Fargo's stock repurchase, we could see FY24 earnings per share to rise around 9% year-on-year. As such, we initiate coverage on Wells Fargo with an accumulate and a target price of $60.83. With that, I hope the trading insights shared today will be beneficial for your investment journey. If you have any questions regarding the US banks or other stocks we cover, you may reach out to the research team or myself. That is all for this episode of PhillipCapital's Market Watch. Do remember to like and follow us on our social media handles and subscribe to us on YouTube. Thanks for joining us and see you soon.